Picture this for a moment. You make one strategic financial move today. You trade a single lump sum of capital, and from today moving forward, your future self receives predictable, reliable income showing up like clockwork. You can think of this as like mailbox money, right? It's no more white knuckle rides on the market roller coaster. It's no more sleepless nights spent guessing what the economy might do next. And well, if that sounds just a little too good to be true, then stick with us for a few more minutes, because we're actually about to show you how smart and forward-thinking families are turning what might seem like boring stuff into a foundation of truly bulletproof, guaranteed income for their future. And what's even more important, we're going to pull back the curtain and reveal how the same foundational mindset that makes immediate annuities such a powerful tool for guaranteed income is also at the heart of the save and spend system, built around the unique power of whole life insurance. This system empowers you to build wealth and secure your future income streams without ever having to hand over complete control to the unpredictable forces of Wall Street, then sometimes have restrictive policies of traditional banks. It's about taking charge of your financial destiny. So, are you intrigued? Good, because we're just getting started. Let's take a look at the financial landscape facing many generations today. There are, I think, three really significant modern worries that keep people like you up at night. The first is longevity risk. We're living longer than ever before. Medical advancements are extending lifespans, which is a fantastic thing, but it also means that your retirement savings need to stretch further than previous generations ever imagined. The big question is, will your money last as long as you do? The second major concern is the disappearing pension. The days of traditional defined benefit pension plans where your employer guaranteed a specific income stream throughout your retirement are largely a thing of the past for most of the workforce. The responsibility for funding retirement has shifted squarely to the individual, primarily through 401ks and similar defined contribution plans. This puts a lot of pressure and uncertainty on individuals to manage their investments effectively over decades. And finally, there are the shaky Social Security projections. While Social Security is a vital safety net, there are ongoing concerns about its long-term solvency and potential future benefit reductions. Many younger generations are understandably worried about the level of reliance they can place on Social Security as a primary source of retirement income. Good luck. Now, here's the good news. For each of these very real and understandable worries, the fear of outliving your money, the absence of a guaranteed pension, and the uncertainty that absolutely surrounds Social Security, there is a powerful solution that offers a promise of a predictable, reliable payout stream in your future. And that solution, at least in part, is the strategic use of immediate annuities. Now, these are designed to do one thing, and they do it very well. They're designed to provide you with guaranteed income for either a set period of time or, my favorite, for the rest of your whole life. So let's break down exactly what in the world an immediate annuity is. In plain and simple terms, at its heart, an immediate annuity is an irreversible contract. I'll say that part again. Irreversible contract between you and an insurance company. You pay the insurance company a single lump sum premium today, and in exchange for that lump sum, the insurance company promises to begin making regular income payments to you, and typically they start right away. You can normally start them within 30 days or 60 days after the annuity has its funds. Think of it like this. You're essentially converting a pile of assets you have today into predictable rivers of income that flow to you in the future. Now, it's really important to understand the different ways these income payments can be structured to fit your specific needs and your circumstances. The most common options are single life annuities, which provide income for the rest of one person's life. When you pass away, the payments just stop. And then, of course, you've got joint life annuities. I bet you can figure out what this one means. Provides income payments for as long as either you or your spouse, or you can designate someone else, is alive. These are super popular choice for couples who want to ensure a continued income stream for the surviving partner, right? For in my family, with me being a lot of times the breadwinner and my wife taking care of the kids right now, that could be a big deal for us, because if I pass away, she needs money. And then finally, there's another option. It's called a period certain annuity. With this type, you choose a specific period of time. So this is not not whole life. This is now you choose 10 years or 15 years or 20 years, and during those years, you'll receive the payments. If you pass away before the end of those periods, then it's kind of like life insurance, because the beneficiary will just get the remainder of the payments for the remainder of the term you picked. I like them. They just provide such a peace of mind for those who want to ensure their loved ones receive a certain amount of income, even if they don't live for a particularly long time. So the natural question is, how does the insurance company determine how much income you'll receive each month for that initial lump sum? Well, it comes down to some pretty straightforward, albeit actuarial math. There are three primary factors that go into calculating your payout. The first, and perhaps the most significant, is your life expectancy. The insurance company uses sophisticated life expectancy tables, which are based on large populations and statistical probabilities, to estimate how long you're likely to live. Generally speaking, the older you are when you purchase the annuity, the shorter your life expectancy is projected to be, and therefore, the higher your monthly payout will be for the same initial premium. The second key factor is prevailing interest rates. Just like any other financial product, interest rates play a role. When interest rates are higher, the insurance company can earn more on the money you give them, which means they can translate that into a higher monthly payout for you. Conversely, when interest rates are low, the payouts might be lower. And the third element is any optional riders you might choose to add to your annuity contract. These riders can provide additional benefits such as inflation protection, where your payments increase over time to keep pace with the rising cost of living, or a death benefit, which ensures that if you die shortly after purchasing the annuity, your beneficiaries receive some or all of the remaining principal. However, these riders typically come with an additional cost, which can slightly reduce your initial monthly payout. To give you a concrete idea of how this works in the real world, let's plug in some sample numbers using today's average rates. So let's consider a male, let's call him 65 years old, I know retirement age, and a female, 65 years old, and then they buy this immediate joint life annuity. If they put in, let's say, $250,000 based on current average interest rates and their joint life expectancy, they might receive a monthly income of like between $1,300 and $1,600 as long as either one of them is alive. Now let's look at how the scale of your initial investment could kind of impact the payout. Imagine two different scenarios with a single life annuity for a 65-year-old individual. With a $100,000 premium, they might receive somewhere between $500 and $700 per month. If they invest $500,000, $500,000, that monthly income could potentially be in the range of, I don't know, $2,750 all the way up to $3,250. As you can see, the larger the initial lump sum, the greater the potential for significant monthly income streams. So, in my opinion, that's some of the reasons why you might choose an immediate annuity. So, why would someone choose to lock up a significant lump sum of money into an immediate annuity? Well, there are several compelling advantages. The first, and perhaps most significant, is absolute predictability. Once the contract is set up, you know exactly how much income you'll receive and for how long, depending on the type of annuity you choose. This predictability can be incredibly valuable for budgeting and financial planning in retirement. There are no market fluctuations to worry about, no guessing games about investment returns. It's a guaranteed income system. Another key benefit is what's known as mortality credits. This is a somewhat unique concept to annuities. Think of it as shared risk pools. Those who live longer than their projected life expectancy essentially benefit from the premiums paid by those who pass away earlier. The insurance company factors these mortality credits into your payout calculation, which can result in a higher income stream than you might be able to safely withdraw from a traditional investment portfolio of the same size. And for those who are not particularly inclined to be hands-on, do-it-yourself investors, immediate annuities offer simplicity. You make one decision, fund the annuity, and then the income payments automatically start arriving. There's no ongoing portfolio management, no need to constantly monitor market conditions or make investment decisions. It's a set it and forget it approach to generate retirement income. Building on that, there's also significant benefit related to protection from cognitive decline risk. As we age, unfortunately, our cognitive abilities can sometimes, decline. Managing a complex investment portfolio at 78 years old or 85 years old can actually become super challenging and leave individuals kind of vulnerable just to making bad financial decisions or even falling prey to scams. We talked about that on one of our recent podcast episodes. With an immediate annuity, once it's set up, there's no portfolio portfolio to actively manage. The income just keeps coming. That's it. So now you get this layer of protection against these potential, right, life-threatening financial challenges that just happen later in life. Now, you might be noticing a recurring theme here: guarantees and control. These are the very same principles that underpin the save and spend system with whole life insurance. Whole life insurance, when structured properly, gives you those crucial guarantees: guaranteed cash value growth, a guaranteed death benefit, and importantly, it keeps your money liquid and accessible before you might ever decide to annuitize or convert a portion of it into a guaranteed income stream later in life. Of course, it's essential to have a balanced perspective, and immediate annuities do have potential downsides and common misconceptions that you need to be fully aware of before making a decision. One of the biggest is the loss of liquidity. Once you hand over the lump sum to the insurance company to purchase the annuity, the contract, I said it earlier, is irrevocable. You generally cannot get that principal back out if you suddenly need or want a large sum of money for an unexpected emergency, so it's a trade-off. You're exchanging upfront access to your capital for a guaranteed future income stream. A lot of times, a lot of people choose that because the alternatives or the places they put their money over their working career just don't provide that. But another significant concern is the potential for inflation erosion. While you can often purchase riders or options on these annuities that provide some level of inflation protection, these riders will typically reduce your payouts. So if you choose a fixed payment annuity without the inflation protection, the real purchasing power of your income does decrease over time as the cost of living goes up. So what seems like comfortable income today might not feel that in 10 or 20 years, and annuities are lifetime income a lot of times. And then finally, there's just the insurer strength risk. So insurance companies are super highly regulated, but there's always a small chance that the insurance company that you picked could face financial difficulties and potentially be unable to meet the obligations that they guaranteed. It's crucial to research the financial stability and ratings of any insurance company that you're considering. Just to make it easy for you, the folks who are watching this video, any insurance company that we've been using or help people get these annuities through, or like we're going to talk about in a second, our save and spend system, whole life insurance, all these things have been in business for over 100 years, and we only use mutual insurance companies because we want to make sure that the companies that we pick for you or that you choose don't actually face these difficulties where you don't get your checks. That wouldn't be bad. To really illustrate the potential impact of some of these cons, let me share a quick story. I once spoke with someone who, during a period of very low interest rates, we're talking like 2%, decided to annuitize a significant portion of their retirement savings into a fixed, immediate annuity. At the time, the guaranteed income seemed appealing. However, a few years later, the interest rate spiked considerably. This individual was then locked into a relatively low monthly payment, while new annuities being purchased were offering significantly higher income streams for the same initial investment. They deeply regretted locking in that low rate and losing on the opportunity to benefit from the later interest rate increases. So, you see the trade-offs? You gain that valuable guarantee of income, but you typically give up a little control, you give up a little flexibility over the initial principal, which I think leads to a very crucial question. How do we aim to secure these guarantees and predictable income stream for our future without completely surrendering the control? This is where the beauty and strategic power of dividend-paying whole life insurance as the cornerstone of the save and spend system truly shines. Think of a properly structured whole life policy as a delayed annuity that you still own and control. From the moment you put $1 in the policy, the cash value begins to grow on a guaranteed basis. Importantly, this cash value remains liquid and accessible to you throughout your life and the policy years. You've got control over when and why you access it. Over time, as the cash value in your whole life policy grows, you retain the flexibility to decide what to do with it. When you reach a point in your life where generating a guaranteed income stream becomes a primary goal, perhaps as you approach or enter retirement, you've got a powerful option. You can choose to roll a portion of that accumulated cash value into an immediate annuity at that future point in time, locking in the prevailing interest rates and the life expectancy calculations at the later date. Think about the timeline difference. With a direct immediate annuity purchase, you give up a lump sum and you start receiving income almost immediately. With the save and spend system, you have a save and spend phase where you accumulate cash value within your whole life policy, benefiting from guaranteed growth and the ability to borrow against it for opportunities and needs. Then you have the optional annuitization phase later in life, where you can strategically strategically decide to turn a portion of that accumulated value into a lifetime income stream if that aligns with your goals. Let's bring this to life with a practical example. Imagine for a second Lisa and Marco. This is a couple, they're both 55, they're starting to think seriously about retirement income. Let's pretend they've got $300,000 sitting in a traditional 401k. Instead of immediately purchasing an annuity, which would lock up all their capital, they decide to allocate that 300 grand into a high cash value, dividend paying, whole life insurance contract. They understand the benefits of guaranteed growth and the liquidity provided by policy loans. Over the next 10 years, the cash value in their policy grows consistently and predictably. You've heard us say that thousands of times. But by the time Lisa and Marco are age 65, so 10 years, they decide that they want to secure guaranteed income streams for their retirement. So at this point, they choose to annuitize $250,000 of their cash value from their policy by purchasing this annuity. Most importantly, they still have $50,000 of cash value remaining liquid inside their whole life policy for potential emergencies and other needs, and that whole life policy is still active. It's still increasing. It's still generating money each and every year. The outcome? Based on their age and prevailing interest rates at 65, the 250 grand annuitization could provide them with a guaranteed monthly income of approximately $1,600 for the rest of their joint lives. Plus, importantly, the whole life insurance policy, with the remaining cash value and the death benefit still in force, potentially providing a tax-free legacy to their beneficiaries. They've achieved both guaranteed income and continued asset control. What if I die shortly after purchasing an immediate annuity? You can typically choose riders like a refund of premium rider or a period certain rider that they just ensure that your beneficiaries receive the remaining principal or the payments and they just continue for a specified time. It's just making sure you don't lose money. Can I inflation-proof my immediate annuity payments? Yes. You can opt for a cost of living adjustment rider. It normally increases your payments over time to match inflation. Or you can just consider purchasing laddered annuities at different points in time, right? Get one now, get one in 5 years, get one in another 5 years, stuff like that. Isn't purchasing an immediate annuity just buying my own money back over time? See, that's a common misconception. Because of mortality credits and the insurance company's ability to earn returns on the pooled premiums, you can actually receive significantly more income over your lifetime than your initial premium, especially if you live longer than average. It's actually about leveraging the power of a larger risk pool. So there you have it. Immediate annuities offer a powerful tool for creating a guaranteed income safety net for your future. But as we've discussed, they come with trade-offs, particularly regarding liquidity and control. And that's where the Save and Spend system, with its foundation in whole life insurance, provides a unique and strategic advantage. It's like this. Guaranteed income from an immediate annuity is a crucial safety net to ensure your basic needs are covered. But the Save and Spend system is the trampoline that can get you even higher, providing guarantees alongside ongoing control, liquidity, and the potential for significant wealth growth before you might ever consider choosing to create a guaranteed income stream. If you're intrigued by the idea of securing guaranteed income for your future, but you also value maintaining control and liquidity over your assets today, then we want to show you a personalized example and illustration. We can demonstrate exactly how a properly structured whole life insurance policy contract implemented today within the Save and Spend system can grow in cash value and then, at a future point that you decide, can be strategically converted into a predictable, reliable, lifetime income stream, all while potentially providing other significant benefits like the tax advantages and the death benefit. To see the numbers for your specific situation and explore how this strategy could fit into your overall financial plan, then I'm going to encourage you to take the next step. Hit the link below in the description and schedule a free, no obligation call with our team. We're here to answer your questions and help you understand how the Save and Spend system can empower you to build a truly secure and prosperous financial future.